Right, 12:30, so we'll kick off. So hi all, welcome to the Q3 webinar. Today it'll be myself and Mo discussing what's happened in the Carrington portfolios over the quarter. And then for this webinar, we'll have more of a kind of in-house focus, talking about what we've done, what we're thinking, kind of how we feel going forward. So as always, please feel free to post any questions in chat and we can address them at the end. So yeah, here are the kind of key talking points we'll be discussing today. Kind of the recent strong performance in Chinese equity, the lot of speculation over AI profitability and US policy in terms of tariffs, US government debt, and how our portfolios have done over the quarter, and then also our outlook heading into next year. So yeah, we'll start off with the kind of macro kind of view, and you can't really talk about macro without including interest rates. So interest rates have been a key talking point over the quarter. In Q3, the Fed finally cut rates for the first time since December 2024, after kind of Fed Chair Powell got a lot of pressure from Trump. But yet inflation still remains sticky at 3% CPI. Which has kind of reduced the potential for more interest rate cuts heading into the tail end of the year. But yeah, Fed Chair Powell kind of put it down to a deteriorating labour market in his Fed speech. He does acknowledge the fact there could be more inflation down the line, but they seem to be prioritising a stronger labour market. So essentially, if they cut rates, there's more kind of investment, economic stimulation, and it will boost employment. But yeah, they're still kind of uncertain of what the potential inflation impact could be from the tariffs. But they're in this kind of difficult trade-off where do they prioritize lower inflation and keep rates high, or do they prioritize unemployment, start cutting rates, and then it can boost employment and not let unemployment get too high. But yeah, in September in the Fed meeting, they did announce that they'd cut rates by 25 basis points, which puts the base rate at 4.5%, which is still relatively high compared to other major economies. And during Q3, we also saw cuts from the ECB, so their base rate's now about 2%, one of the lowest of the major economies, and then the Bank of England held rates. And then moving on to kind of the tariffs, obviously the headlines have calmed down a little bit from Q2. Q3 was a little bit more stable, but they're still coming out. But the hard economic data we've been seeing coming out of kind of Q1, Q2 is still quite distorted due to the fact that a lot of companies were front running during Q1. Trump was very vocal during his campaign for the US presidency that he wanted to implement tariffs. Obviously, due to the market reaction on April 2nd, it wasn't aware of to that extent. But still, during Q1, a lot of companies were front running, purchasing materials and any sort of products abroad, and kind of storing a large amount of inventories. So yeah, since then, the kind of anti's calmed down a little bit. In Q2, Trump has been sending letters to countries, kind of establishing what the trade deals are. And then yeah, the US-China has come into a truce, which is good for a lot of people. I think that was the kind of the most important trading partnership that the market was worried about. But since he's kind of laid out a lot of these country-specific tariffs, the average tariff rate for US importers are now about 20%. And Trump seems to be focusing his attention more on industry-specific tariffs. So he's targeted things like cars, steel, aluminium, and pharmaceuticals, things that he thinks should be built in the US. And then also, yeah, as I kind of mentioned, inflation's been a bit sticky. Currently, the US CPI is at 3.1%, which is above the central bank's target of 2%, but plus or minus 1% there. So just a little bit above it, but it has been gradually increasing since Liberation Day. However, it was lower than expected US CPI. So markets actually kind of rallied on that information. They expected the impact of tariffs to be more inflationary than the 3.1% figure that came out. But one thing that was interesting to note is when the kind of manufacturing data, specifically PPI data, came out, it increased more than the kind of consumer inflation. So what we were seeing was in the US is a lot of companies were kind of taking the hit on the inflationary aspects of the tariffs. So instead of passing it on to the end consumer, they were reducing their margins to avoid increasing prices too much for the consumer. But what this happens is, in theory, it should reduce company earnings, and stock prices are based on discounted future earnings. But yet, kind of equities continue to rally. But we must bear in mind that kind of a lot of the data that's come out is quite distorted. So time will tell what's happened there. But yeah, economists are predicting the tariffs will be inflationary, but Trump is very confident that they won't be inflationary. So we'll kind of see later down the line. But one thing economists have been predicting is that tariffs are kind of harmful for economic growth. So it's been estimated real GDP will decrease by about 0.5% to 1%. And in Q1, we kind of saw a different GDP print. So it came in at -0.5%, which did alarm a few investors, but it was a lot of people kind of saw through that and then saw that kind of companies were front running tariffs. If you have a lot more imports in Q1, it's kind of a leakage to the economy, which reduces the GDP print. But most of the concerns came from the fact that it could lead to 2 consecutive negative quarters, which is a technical recession. So if you saw that there were headlines of a US recession, it might start kind of panicking to people. But in Q2, we saw a complete reversal. So instead of compared to the -0.5% GDP print in Q1, Q2 GDP came in at positive 3.3%. So yeah, pretty big swing. As a lot of these companies were sitting on inventory reserves, didn't need to import, less kind of leakages to the economy there.
Over to me. Good afternoon, everyone. Thank you very much for joining us again. So we thought we'll run through some statistics for the quarter from the various major markets in both local currency terms and in sterling terms. So as you can see, across the board, it was a very positive quarter for equity markets, as well as gold in particular. You can see that there was some help in terms of overseas currency. So, for example, if you look at the S&P 500, which is denominated in dollars, there was some help from the currency angle, meaning that the sterling return was slightly higher. But yeah, very strong numbers across the board. And if you see in particular the Hang Seng, which represents the Chinese stock market, this is quite important to us, as I'll talk about shortly. But again, one of the strongest performing equity markets over the quarter, which has built on a very strong year for that particular market. Move to the next slide. What we thought we'd do is give some more insight into what we've been up to in portfolios, not just in the previous quarter, which Lucas will come on to shortly, but also with a slightly more longer perspective. And the reason we're doing this is because some of the things we've done have really paid off this year and in Q3. So we thought it'd be helpful if we could run through some of the way we think and how we construct portfolios. So this is a performance chart of the Chinese stock market, as represented by the Hang Seng. As you can see, it was a really tough place to be up until early 2024. And if you actually zoomed out a little bit more, you would see that this pain actually continued for at least 3 to 4 years prior. So it was quite a material drawdown in that particular market for a variety of reasons. I'm sure many of you would have seen sort of various headlines around that. Meanwhile, other equity markets were enjoying very good positive returns, particularly in the US. So no surprise, typical investor behavior. The interest in Chinese equities diminished significantly, even amongst the fund management industry. You know, we meet fund managers all the time. Even they had gone underweight China and had no interest in investing. Usually what happens is we start to pay attention to these sorts of extremes, because usually they don't last, and that's whether that's a positive extreme in terms of exuberance or a negative extreme in terms of extreme pessimism, we're normally paying attention. And we decided that we wanted to actually increase our allocation to China in late 23, early 24. And the main trigger for that was we started to see headlines saying things like China is uninvestable. And for us, that was the point at sort of peak pain. Everyone we were speaking to had no interest whatsoever in the market, in the Chinese market, and pretty much every fund manager that we knew was underweight. So we thought that actually that's probably quite a good contrarian signal, and we should go against the herd and increase our allocation, actually go into an overweight position, because at the end of the day, the Chinese stock market and Chinese companies, are globally very important, very dominant in a number of industries, and it made very little sense from a sentiment perspective, but also from a valuation perspective, that they were trading at those multiples at the time. So what we did is we increased our allocation to a particular strategies that we had in the portfolios, which on a look-through basis increased our China exposure, and that was particularly in our core portfolios where we blend active and passive strategies. One of the active funds that we had was very overweight China. They had a similar sort of view to us, and so we simply just allocated more to that fund. To move on, our conviction built through 2024, and in January 25, we bought our very first China-only fund in our core portfolio specifically. And then Liberation Day came in April, and we saw that as an opportunity to bring some more in. So now we've got quite a substantial overweight in China, which has been enormously beneficial because the Hang Seng has been one of the strongest performing equity markets this year. If we move on to the next one.
We'll just jump in there quickly. Yeah, so relative to the Hang Seng, so in the last 18 months, it's an interesting fact. So 18 months, Hang Seng has actually outperformed the S&P 500 by nearly 30%. When kind of the US gets a lot of the spotlight of kind of its US exceptionalism, very amazing. But yeah, it seems that China's kind of snuck in the kind of back door and outperformed them, which is beneficial to us having an overweight there.
Lots of news around gold at the moment, and so we thought it would be topical to bring this in as well, because again, it's been a strong performer for us. Many of you may not know that we actually introduced gold to the portfolios in Q1 2019, when gold was trading at about $1,300. We took the view to double our exposure in early 2024. We were very bullish. That clearly paid off, as you can see from that chart. We felt that gold had perhaps overextended in the short term, so we decided to reduce our exposure to the original weighting we had when we first bought it. Gold has actually just carried on going higher, and as you may have seen this morning, crossed through $4,000 an ounce for the first time ever. We think that at some stage an opportunity will come in order for us to sort of allocate more to that, and we are actually thinking about other precious metals as well, not just gold, which has been the strongest performing precious metal over that time frame. But again, it's been a very strong performer for us, and generally not owned amongst our peer group. And so again, a bit of a differentiator for us and a strong driver of returns. This just gives you what's happened over the quarter. So, as I mentioned, very strong returns across different markets. What you can see here is all of the various portfolios that we operate, all the way from our adventurous, which are largely 100% equity portfolios, all the way down to our sort of cautious portfolios, which are typically 40% in equities. But yeah, across the board, very strong numbers. If we move on to the next one, This is our growth portfolio, which is typically 80% equities versus some of our major peers in the industry. I think some of you would have seen these before. This chart, it's the same group that we've been using for a long time. Collectively across that group of competitors, I think they manage sort of 300 billion, so significant players in the market, and it's good to see that we've done a very good job on a relative basis. And if we go to the next slide, this is again on a year-to-date basis, so this includes all the way up to a couple of days ago. So again, very strong performance for a variety of reasons, but some of which I've already talked about, namely some of our precious metal exposure and also our overweight to China.
Nice. So yeah, getting into kind of what we've been changing over the quarter. To be honest, it's been quite a quiet quarter. We had a very active Q1 and Q2 because of lots of volatility. So new administration in the US, there was kind of a rotation between growth and more value. So we were very active there. But yeah, in Q3 we made kind of the switch for the Royal London Sustainable Leaders Fund in exchange for the Ranmore Global Equity. So the Royal London Fund was essentially kind of a UK equity fund that had about 80% exposure to UK equities. But what we want to do is gain a little bit more European exposure, as most of our European exposure was through previously kind of global equity funds, and we don't really have a direct European fund. But where we were kind of attracted to Ranmore was the fund manager was doing something completely different, where they were highly active, had a bit of a value bias to them, and they were able to pivot very quickly between themes. And we kind of thought with all the volatility that was happening, there could be kind of interchange between themes quite rapidly. But the fund has incredible track record, given it's a value strategy, and growth has just been dominating markets over the last kind of 5 to 10 years. But yeah, these kind of style shifts come in phases. If you look over the last kind of 30 to 40 years, values actually outperform growth. But a lot of the kind of growth orientated tech stocks been kind of leading the charge over the last 10 years or so. But yeah, the Ranmore fund is a global equity fund. It ranks in the top 5 of gross performance out of 570 other funds in its sector, which is very impressive considering most of those funds are quite US heavy. It's been able to keep up without having kind of that high US exposure that a lot of funds have. But the manager, Sean Pesh, he has a very unique way of thinking. If you're ever kind of interested, he has lots of podcasts or YouTube clips of him talking, and yeah, it's very interesting and kind of very different, which we like, and it gives the portfolio good diversification. But yeah, kind of a key theme in the fund is the struggles coming out of the US, specifically with US government debt and the inflation aspect, and also the lack of trust with Trump himself. And as a result of this, he has a very low exposure to US equity, specializes predominantly in European equities, UK, and a bit of China in there as well. So we made this switch in July, and yeah, it's been performing really well since. So it's been a bit of positive switch. And yeah, the kind of European outlook's looking rather attractive at the moment. I'm sure you've seen the kind of EU additional spending regarding defence. But yeah, we don't like to enter in kind of areas like European defence, where some of these names, such as like Rheinmetall or Leonardo, have gone up over 200% plus. That's kind of not really what we'd want to go into. But yeah, Ranmore have a unique way of finding these undervalued names in Europe, and then essentially can generate superior returns as they come back into favour. But yeah, moving on to our outlook. Obviously, AI is a very hot topic at the moment. It has been for a while, but it seems like the sentiment's changed a little bit. There has been a lot of speculation over the potential there could be an AI bubble. Currently, the S&P 500 is trading on an average price earnings multiple of 30 times. And this is relative to a historical average about 18 times. And then when you kind of adjust this to the current economic cycle, it's actually the most expensive the S&P's been since the dot-com bubble in 2001. So these kind of stats are alarming a few investors, but still kind of the Magnificent Seven keep going on. Investors kind of piling into it. But yeah, where the concerns are coming is the level of capital expenditure by these US tech giants has been enormous, and then they further plan to spend about 500 billion annually on AI infrastructure, kind of up to the early 2030s. And like this wasn't much of a problem for tech companies kind of in the last decade, where they could borrow money cheaply, they could kind of go spend big, and they don't have to worry about servicing the debt until kind of they just get rolling over. But now it's different, where borrowing's quite expensive and AI is yet to actually produce a profit. This has left investors worried. And the AI profit is more on the people that create these kind of large language models, rather than your likes of NVIDIA or TSMC that will sell chips to kind of the software developers. But yeah, there's a lot of spending. There's kind of a race to see who can get to the final superior product. But what we're seeing is, because more companies coming into it, I'm sure all of you use ChatGPT, you've got Grok as well, you've got DeepSeek, Perplexity, all these different ones. And they all kind of have a free version and a charge version, but they're just struggling to produce profit, because if they start, let's say ChatGPT increased its kind of monthly subscription, bear in mind if you're already paying for it, monthly subscription to $1,000 or something like that, to make it profitable, you're just going to go to DeepSeek or Perplexity, where you can get it for a lot cheaper. So they're in a difficult position now, where they can't really raise prices unless they have a far superior product. But all of them kind of do something quite similar, using the large language models, and essentially you need user traffic to learn to kind of get these models to learn and develop. But OpenAI, the kind of creators of ChatGPT, are still yet to turn a positive cash flow, considering I think they were valued at the most expensive private company at the moment. And they're estimating they won't turn cash flow positive until 2029, and they still burn through billions and billions of cash annually, relying on the likes of NVIDIA's to keep funding them, and Microsoft. And then yeah, this kind of cycle of capex is alarming some investors, is yet to yield a return. So they could have kind of problems down the line if they aren't able to monetize this kind of great technology. But yeah, Mo's touched on China already. But yeah, China's had really good performance, and the Chinese kind of AI tech story has been advancing quite nicely. I mentioned DeepSeek, that came out I think January, February. That kind of alarmed a lot of people that maybe the US isn't the only place to get AI exposure, and that's kind of what we're thinking as well. These Chinese tech names are trading at fractions of the kind of valuations that the US counterparts does. So we see kind of a better risk and reward profile going forward on these Chinese tech names, and that's kind of how we reflected it by buying into the Chinese Hang Seng Tech Index during kind of the April dip or so. We remain bullish on China, so their economic position is quite strong. Inflation is very low, economic growth is strong, although you have to put kind of some doubt into figures. But yeah, the kind of reporting looks good, and they still have plenty of room to cut rates. Their rates are actually quite high at the moment, but they're doing that from more of a currency perspective, because if they were to start cutting rates, they could get kind of large currency fluctuations, and kind of what a lot of EM countries are doing, waiting for the US to cut rates, so they can do that as well. But yeah, the US and China seem to be on better terms. They're still on their truce. They've kind of had representatives meeting each other, so the market responds very positively to that. And even though kind of all the stuff that unfolded during Q2, China managed to increase their total exports, despite completely reducing the exports to the US. They've managed to strengthen ties with other neighboring countries. So we definitely see future upside there. So yeah, I talked a bit about kind of Trump and Powell earlier, but yeah, there's been a lot of changes in interest rate expectations over the last 2 years. Trump has been very vocal on pressuring Powell into cutting rates, and he essentially got his wish in September. It was the first rate cut under the Trump administration. So yeah, he was happy, but straight on True Social after, saying it should have been a half point cut instead of a 25 basis point cut. So yeah, I don't think he'll ever be happy. But the market is still the market is expecting the Fed to cut rates again with the meeting later this month. Currently, the market's pricing a 90% chance of a cut when they meet in a couple of weeks. However, despite that, inflation's still sticky. But yeah, as Powell said, he's putting the rates down due to a softer labor market. But with unemployment historically still low, they are prioritizing unemployment, but it's still kind of low compared to historic averages. So it kind of makes you think how much of this is political pressures, Powell maybe feeling the heat a little bit. But compared to that, well, in comparison to that, a lot of people are now concerned over the Fed independence. Trump's been very vocal on Lisa Cook, pushing for kind of should get her fired from the Fed, and then implementing people to push for lower rates. And it looks like almost he could get his wish because Fed Chair Powell's job is up for grabs in May next year. That's just when his term comes to the end. So it's almost kind of like a lot of these Fed governors, if they could kind of get in Trump's good books, always push for lower rates, then he may be kind of favorable to them when it comes around to deciding who's going to get the top seat. But considering how he's treated Powell, I don't know who could be too interested. As you can see, a tweet there, well, a truth they call it on his Truth Social account, calling Powell Mr. Too Late and a major loser, which is very presidential of him. But despite all this conflict that's going up, US markets have plowed on since the April lows. Major stock markets around the world are now reaching new all-time highs. US house prices at all-time high, Bitcoin's at an all-time high, gold has reached an all-time high, money supply is at an all-time high, and national debt is at an all-time high. Inflation remains above the target and hasn't actually reached the 2% goal since February 2021. And now the Fed seems to be cutting rates consistently. So yeah, a few things there. It's quite interesting. But with all of kind of the government debt, inflation, the US government debt has become more of a concern as treasury yields do tick up. Some of you might have seen that the US government is in a shutdown at the moment. So this basically means they run out of money for day-to-day operations. So last week we were meant to get some labor market data coming out of the US and didn't get released because no one's at work because they run out of money. So that's another problem there. And yeah, it just makes you think, kind of doing a bit of reading about this. So kind of politicians used to control interest rates, but then they became too political. And then it was actually switched where the Fed were kind of independent back in 1951, and they got to say where the kind of interest rates were, so not let the politicians do it. But this is where you could see government spending heading, with the West having enormous debt levels and they're struggling to service the debt. They can't cut spending because it doesn't get voted through, or the government just gets voted out. So does this make sense to eventually be in a position where the government budget is done by an independent party? Who knows? But that's just a kind of a thought. But yeah, moving on. Some of you might have seen this catchy acronym that's been going around, TACO. So Trump always chickens out. He kind of got that over the tariff mania of Q2. But US policy seems to have calmed down a little bit. Tariff headlines have reduced. Kind of his level of tweeting is reduced. But yeah, most recently, Trump implemented a 100% tariff on pharmaceuticals coming into the US. This was his kind of most recent one, targeting specific industries. But then kind of with that tariff, he did say that companies that have operations already in the US and planning to bring them into the US are exempt from that. So this includes the likes of Novo Nordisk, kind of the largest European pharmaceuticals provider. But then a few days later, kind of did a bit of a TACO moment, and Pfizer, it was reported that Pfizer actually already made a deal with Trump a few days later, and they weren't applicable to the 100% tariff. So once again, yeah, gaining the Trump always chickens out acronym. But yeah, it seems to be kind of a reoccurring thing, and are markets as sensitive to kind of what he's posting? Maybe not, but yeah, there could be kind of some method to his madness of firing tweets constantly, but it certainly makes it interesting on our side. So yeah, with Bitcoin reaching a new all-time high of $125,000, I think it was worth talking about. And then yeah, recently, as of today, actually, the FCA are now lifting a ban. The FCA have been well behind the pace for a couple of years now, in terms of allowing UK retail investors to buy crypto-related products. So as of today, UK retail investors can buy, let's say, a Bitcoin ETF or ETN. But yeah, the FCA are quite late to this. The SEC in the US approved this nearly 2 years ago. And since then, the price of Bitcoin is up 170%. So yeah, it's kind of put UK investors a little bit of a disadvantage. But yeah, you could technically still buy Bitcoin in the UK previously, but having this kind of like ETF product makes it a lot easier. Like you could just go buy on Binance or Coinbase, but that comes with a lot of problems. So like security is one of them. You don't have to go remember a load of passwords, or I'm sure you might have heard of this story of someone that put a few thousand Bitcoin on a USB drive and lost it, which is worth like 500 million today, or people forget their passwords. Like it's estimated that about, I think it's 20% of the Bitcoin supply is actually lost from when it was created in the kind of the early 2010s. And then on top of that, these kind of crypto platforms have quite high transaction costs. And then also, if you have it in an ETF form, you can include it in tax-free wrappers, such as an ISA or pension. So yeah, a lot more flexible. But an interesting point to note is kind of how ahead the US in terms of the UK and cryptocurrency adoption is. That even the two main mortgage providers in the US, Fannie Mae and Freddie Mac, announced a couple of months ago that they will allow mortgages to be secured with crypto as collateral. So this could open up kind of a whole new avenue for storage of kind of value within in crypto space. And yeah, crypto adoption keeps expanding as money supply skyrockets. Governments kind of the only way to get out of their debt is to inflate their way out of debt, and companies now seeing the harm of holding cash on their kind of balance sheet reserves. So what we've seen in the last few months is that a lot of companies are now adopting Bitcoin corporate treasuries instead of holding cash, and using the kind of Bitcoin treasury as a kind of short-term capital management. And then yeah, Bitcoin seems to hold its value better than cash at the moment, and it seemed to work. I think Tesla was one of the early adopters of doing this, and it worked quite well for them. They're one of the kind of top 10 largest Bitcoin holders, and it kind of sits on their balance sheet. So kind of final point, just kind of a funny one to end on. Some of you might have seen the kind of American Eagle ad campaign that happened with Sydney Sweeney. It stirred up quite the PR masterclass for the company. The ad went pretty viral, kind of the collaboration there. And American Eagle stock actually went up 20% since the ad came out. Kind of one of the best ads, I think, in terms of stock price movement and shareholder value creation. And supposedly the jeans have been flying off the shelves over in the US, and it was actually later revealed that she was a Republican voter. So yeah, no surprise that Trump was very quick to side with Sydney Sweeney during all this controversy, kind of claiming how she's a Republican voter, and he even said he loves her ad, and yeah, I'm sure he did. But yeah, that's kind of everything we wanted to touch on today. So we'll now kind of move on to kind of Q&A sessions. Let me just try get the question bank up. Let me just stop sharing. Sorry, guys. Okay, so we got one question. What do you think about the other precious metals compared to gold in terms of the relative kind of strong run of gold's been on?
Yeah, I touched on it slightly earlier, but traditionally, when there is a strong run in the precious metals sector, usually the other precious metals outperform gold. That's happened in the last sort of three major bull markets over the last 20 years or so. This is the first time that gold has actually outperformed the others. This year, I mean, certainly recently, silver sort of recovered some ground, but if you sort of zoom out, there's still quite a bit of catch up to do from the other precious metals. So we are thinking about broadening our exposure to not from out away from physical gold to the other gold and the other precious metals, because I think there's still a lot of runway there for all of them, and particularly the ones that are not gold.
Brilliant. Thanks. Well, I guess we'll wrap things up there. So thank you very much for everyone joining it. I hope you learned a few interesting points, and let us know of any follow-up questions. But yeah, all take care. Enjoy the rest of your Wednesday afternoon. So bye, everyone.
Thank you. Thank you very much.